We have 4 hours of content. We just wrapped up hour number 1. That was Jack Gleason at Major League Trading, and he was talking about Nadex. I personally met Jack in last fall, and he was telling me about this course that he had, and that's when I first started getting him involved in Trade Thirsty, and we have had nothing but great feedback from the people that are taking this course, learning about Nadex and making money with it. So hopefully if you haven't yet taken advantage of his offer, you'll go do that now. Our next speaker tonight is Mr. John Thomas. Can everybody see that? John Thomas is a mad hedge fund trader, and he's going to be talking about how the rest of 2016 will play out. And I'll let you guys know that he is a first-timer on here at Trade Thirsty as one of our guest speakers, and that's something I try to do pretty regularly, is bring in some new gurus out there in our world, good traders who are real and legit and can show me that what they're doing works, and we take them on recommendation for you. So anytime you've got somebody that you think would be willing to come in here for an hour and teach for free and spend some time with those who attend the events, you can send an email to help@tradethirsty.com, and we welcome comments of all sizes. So if you liked it, great. If you have feedback that's not so great, we'll take that too. We're always willing to improve. All right, so I'm going to make John the panelist now. Let's give him the mic and the ball so that he can put his PowerPoint up. We'll test his mic, make sure we're all good to go. I'm making you the presenter right now, John.
Hello from San Francisco.
Hello, San Francisco.
I'm going to show my screen. I'm going to start my PowerPoint. Can you see me?
I see you, Matt Hedge Fund. I see you.
Okay.
I just want you to know
that is the real me.
John just told me that Macs are required in California, y'all. So I'm going to let him play that out here.
Well, not only that, but if you get a Mac, they have this extra app that lets you log straight into Hillary Clinton's cell phone, and you can hear everything she says.
You probably can check her email too and get CIA.
And you check her email, and it's a free app.
Oh my God, that's awesome! All right, I'm going to give you 1 hour, Mr. Thomas, and I'll be right here if you need me. Mike, and let you take it away. Y'all welcome John Thomas, first time here at Trade Thirsty.
Well, okay, I'm going to have to speak loud since it's a long ways to California. We are 2,000 miles out on the West Coast and maybe 20 years into the future. So come out and visit us sometime if you want to know what's coming next, at least in terms of technology. I'm calling my webinar today the Flip-Flopping Fed because that's exactly what the Fed has been doing for the last year, making the lives of investors and traders miserable everywhere. I am the real guy. That's me. That's my Marine Corps pin. I was a combat pilot in Desert Storm, proud of it. I do all the trades. I'm responsible for everything that happens, good and bad. I eat my own cooking. Let's see. Jeanette, did the slide go forward? I'll assume it did.
Yes, sir, it did. You are good to go. I see a pretty girl and a bunch of...
That's one of the only things that can go wrong with a Mac is sometimes the slides don't advance. Why listen to me? Well, 45 years of experience in the global financial markets. I was the Economist magazine correspondent in Tokyo, Japan for 10 years. I ran the international equity division at Morgan Stanley for 10 years. I spent 5 years fracking for natural gas in Texas, 9 years publishing Diary of a Mad Hedge Fund Trader, and I'm one of the founders of the modern hedge fund industry. The other reason you listen to me is the only one that counts, my 5-year performance. Been running the newsletter for 10 years. The last 5, we've had a trade alert service. The average annualized return of that service is 38%. Basically, we try to make money at all times and all market conditions. These are daily audited results we post on our site every day and send out to all of our paying subscribers. This is what a professional hedge fund looks like in terms of performance. And in the last year or two, it's actually better than most hedge funds. If you're not up 38.1% in the past 12 months as I am, you are reading the wrong newsletter or following the wrong trade mentoring service. You probably know better than I that there are a lot of pretenders out there. This is the real deal. The good news, it gets easy after you've been doing this for 50 years, as I have done. I share my complete trading portfolio with you every day. This was the March 31st position sheet we had. We had a long position in gold, short position the S&P 500. At that time, I was running a small book because volatility was high. As it what turned out, all these positions were profitable. They all maxed out at their maximum P&L to bring us up 10% on the year. Short-term strategy outlook. It's all about the strong dollar. European rally triggers another short squeeze, but it's not sustainable. It's just algorithms and high-frequency traders trading the air gap between 2000 and 2010 in the S&P 500. Dollar looks to stay strong through May, so you want to short all the weak dollar plays, including commodities, energy, and foreign currencies. And 3 out of 4 of those are working great. Oil seems to be levitating through its own magic. Dollar has averaged a 3% gain for the last 7 Mays on international trade flows. This year is no different. Oil bottom at 26 is looking rock solid. We could hit $60 by year end, but expect a lot of volatility between now and then. We still have a ton of supply, and of course, geopolitics is an ever-present danger. U.S. stocks have now defined a 2016 wedge formation between 1812 and 2010. It'll take a good 3 months for a true upside breakout. We may get a couple of false ones before then to suck people in. Watch out for those, especially over thin summer conditions. And despite the Fed shock that we got last week on the April minutes, bonds are trading at a range at a very high level, setting up another wedge formation on the charts for a December rate hike. I'm not a believer in the June hike. The rate rise prospect, however, did take the shine off gold. That's off the table for the time being. You don't want to own gold in a rising interest rate scenario. And the ags of just having another disastrous year, unless you're in soybeans, I would just forget the whole sector. Too many other interesting asset classes to trade. And by the way, that's me. I work out of Switzerland every summer, climb the Matterhorn at least once a year, hike 10 miles a day. You got to stay in shape to do this trading stuff. Otherwise, it'll be bad for your health. Here's the problem with the U.S. markets for the last 2 years. This is why we've gone nowhere for the last 2 years. Quantitative easing, the super accommodative monetary policy from the Federal Reserve, ended 18 months ago. Since then, the progress in the stock market has been absolutely zero. No QE means no bull market. It's taken 2 years for earnings to catch up with stock valuations, which is why I expect a new breakout to a new high in the second half of the year. But it does explain why we've had a lot of churning and toing and froing since 2014. The Fed took the punch bowl away, and we had to pay the price as stock traders. Global economy is choppy, to say the best. Hints of a June Fed rate rise suggest that the U.S. economy may be stronger than we think. German GDP is seeing the strongest growth in 2 years, jumping from 0.3% to 0.7% growth. Europe, it turns out, had the best performing major economy in Q1. That's supporting the euro. It's also allowing European stock markets to outperform ours, believe it or not, even though the long-term fundamentals there are poor. We got a nice little pop this week in retail sales, much better than expected PPI gains. However, new commodity weakness is undermining Australia. No news from China is good news. Falling yen is bringing Japan back to life, but not by much. Oil is sort of stalling here, trying to decide if it wants to top out around 50. But the pink trade is still to the upside. That'll be the surprise if we just keep on going straight to 60. I doubt it'll happen, but boy, having traded oil the last 5 years, nothing is impossible. Next to come is a risk-on global synchronized growth in the second half of this year, now that the Q1 mini recession is behind us. Weekly jobless claims. You have any doubt about the health of the American economy? Look no farther than the jobless claims, which is the most reliable coincident economic indicator you can look at. We are close to 40-year lows in weekly jobless claims. We just touched that number a few weeks ago. Show me the recession. It ain't here anywhere. So how this year ends. What have you got to do for the next 7 or so months? Well, QE in Europe is working, boosting the economy. We're seeing that in the GDP figures. A European recovery then brings a Chinese recovery, since Europe is China's biggest customer. A Chinese recovery reduces U.S. financial market volatility. Suddenly, U.S. investors realize that 1812 bottom that we got in February is rock solid. That would give you a 16 multiple in a negative interest rate world. That puts a very high floor under stocks. That's why we were unable to crash recently below 1812. That's why we can't even get below 2,000 in the SPYs right now. Stable to falling dollar in the second half brings emerging country commodity and oil recoveries. The U.S. election gets out of the way, thank goodness. That reduces uncertainty. Ka-ching, the global synchronized recovery is back. Buy, stocks going to new highs. By the end of the year, probably 5 to 10%. Higher from here, play it from the long side. So what do we do about all this? Well, stocks, for the short term, you want to sell the rallies. Next time we get a big dip, buy it. Eventually we break out to the upside, but that could take anywhere from several weeks to several months before we actually get it. We've had so many failed breakout attempts in the last 2 years, people are going to be fading every attempt going forward. Bonds, you want to buy the dips. We're probably going to run the new highs. Might even challenge all-time 60-year lows in Treasury bond interest rates. Commodities is in, but only buy the big dips. You want to trade it. Currencies, buy the British pound. I think the Brexit's going to fail, and you want to short yen and euro against it. Precious metals, we played gold from the long side all the way until a week ago. Second we heard rates might rise, we bailed, cut everything, and laughed all the way to the bank. Volatility, you want to short every spike over 25, buy every dip to 13. Right now we're in a 13, 17 range. You can probably turn that over once or twice a week. Ag, stand aside. God bless American farmers. Boy, can they produce. Unfortunately, that's terrible news for prices. In real estate, we're about to enter a roaring 20s. The next real estate bubble doesn't start for another 4 years. Long term, we're looking at a major structural bull market for anything connected with home construction. Bonds, we got a Fed shock. April Fed minutes chopped 3.5 points off of bonds quickly. Then it held. Should have gone a lot lower if we really were going to get a Fed rate rise, which makes me suspicious whether we get a Fed rate rise or not. One good global risk-off move, and bonds could take a new run at the highs, lows in yield. 10-year Treasury could go all the way down to 136, which is the last low we got 2 years ago in the bond market. Japan government bonds actually managed to rally all the way up to negative 11% for a 10-year. That means if you buy a 10-year bond, it costs you 10% a year to keep it. German bonds have an actual positive interest rate, one of the only ones in Europe, positive 18 basis points, almost a guaranteed loser over the long term. But that's what quantitative easing gets you, is zero interest rates. Emerging market debt did give up its recent gains thanks to the strong dollar and weak oil. Risk on is taking junk bonds to new highs, and that'll be an interesting chart. Global rate collapse, you can see how international rates moved sideways for all of last year and then utterly collapsed once we got into 2016. You can see our 10-year treasuries up here at the top, German yields, Japanese yields down here. Means buy the dollar, buy U.S. treasuries. That's why I think they're going up. It's that simple. Our bonds look expensive. Our yields look generous. Yes, I know, 1.86% doesn't sound very generous, but that's the fact. 10-year Treasury, I'm currently long June 124, 127 vertical bull call spread. This is really looking, you take the name off this chart, you would say, wow, this thing's grinding sideways, making a nice little flag pennant, and is ready to break out to the upside. Until you tell people this is Treasury bonds and the upside is a 1.36 yield. Hard to believe, but, the market is always right. You got to read the music that it's telling you. Junk bonds. Basically, junk bonds are preferred stocks, essentially. They move one-to-one with stock markets. They are a great coincident risk-on indicator. And we got new highs for the year this week. So look for higher highs, but no real move until we get a breakout to the upside in the stock market. Stocks just had a great short covering rally on fading Brexit prospects, strong new home sales, big M&A deals, and failure to crash. I mean, in a market that's dominated by algorithms and short-term traders, mere failure to go down is a reason to buy it, and we just couldn't break through that 2,000 level in the SPYs last week, so they took them right back up, and they basically traded 6 points right on air. But stocks at a 2-year range with decade-high valuations at a 19 times multiple, upside is limited, and I think it's going to be tough to get through 2012 the first several times. We are seeing rotation from growth to value stocks and small caps continuing. These are all stock plays you want to do when the dollar is strong. Shorts are all gone now, but no one wants to play on the long side, at least for the short term. Hot money did rush back into tech as losing hedge funds desperately chased performance. How much stock do you want to buy ahead of sell in May and go away? Calendar is hugely negative for the next 3 months. S&P 500, here's a 6-month or 9-month chart, and you can see top here, top here, top here, another top here. No wonder we're getting such huge resistance right around this neighborhood. Took another run that started last week. Probably fail here, chop around for another couple of months, and then break out to the upside. We did have profitable positions in the 173.78 call spread, the 76.81, and the 212.217. We took profits on all of these, all good money makers, trading these various spreads. S&P 500 here is a 8-year chart, and you can see the major trend lines that are still in play. We've just finished a wave 4 correction, taking another run at the highs here. This trend line is held every time, but we had to chop sideways for 2 years to get there. It says the bull market is intact and probably has at least a couple more years to run. So don't be in a hurry to sell those stocks. Don't get flushed out on these big panic sell-offs. NASDAQ, sector with the best fundamentals and the prices. I mean, this is going to lead the market for the rest of the year. So when we do get a breakout, you'll only know if it's real if NASDAQ is participating, especially the high-quality old tech stocks. They are the market leadership for the long term. That has been the case since 2009. That will continue to be the case for the life of this bull market. So watch NASDAQ carefully. It sold off more than the other indexes this year, and it is a bargain. Let's see. Do we get a summer correction? Well, the worst case only takes us back to that 1812 low we saw in February. Below that, you need a real live recession. There's no way you're going to go below a PE multiple of 16 for the S&P 500 in a negative interest rate world. Stocks are just yielding too much. I mean, they're yielding close to 2.5% now. I get 0 in the cash market, and that is 80 basis points higher than our treasury market. So it's rare when stocks yield more than treasuries. It makes stocks artificially cheap compared to bonds. So Not much downside in that scenario. That is why we failed to get more than a 10 or 12% correction for the last 2 years. VIX, this has been a great trading vehicle for us. We shorted both of these spikes back here in January, February, made good money. You can make a lot of money shorting the VIX, but your timing has got to be pretty accurate. This was a double top. You could see a mile off. We sold the hell out of that one. Oh, excuse my French. We sold the daylights out of that, the dickens out of that, and took it right back down to 13. We've been trading in a 13, 17 range ever since. Day traders having a lot of fun with this. So it's something to do in an otherwise tedious market. Russell 2000, watch this very carefully. It's been a great leading indicator of risk-taking for all markets. As soon as we knew this thing rose up to this point here, we knew it was ready to retest the highs. I think it fails again, but you have a very positive technical situation here with a golden cross, the 50-day breaking to the upside through the 200-day. You can look at fundamentals all day long, but never ignore a golden cross on the charts. You got to think like a fundamentalist and trade like a technician. That's how the big hedge funds do it. That's how they make a lot of money. That's how I make a lot of money. VIX back to the bottom. We covered that. Apple, yes. Waiting for the next real catalyst, the iPhone 7 launch in September. Last week, Warren Buffett basically gave the world a free put option on Apple, announcing that he was buying $1 billion in stock after ignoring the stock for the last 40 years and being friends with Steve Jobs. He never, ever touches technology stocks, but this got so cheap. My bet down here, we got people into the calls on Apple down below 90, and my theory is that Apple was getting so cheap, with $230 billion in cash, 8% or 2.5% dividend yield and 8 times multiple. It was so cheap that every value player in the world had to buy this thing, or they'd get fired, for not being value players. So I think we have a decent run back at least to 120, maybe even the 130 high we saw last year. Microsoft, another game-changing company here. After being dead for 10 years, it's come back to life. A bad earnings report gave us a great entry point back here. We did play the call spreads back in January, made money, came out. Now we're looking to go back in. And you can see how it led in that short covering rally that started this week. Facebook basically is the new Apple, and it's almost the only tech stock that hasn't really gone down much. Tough to buy. It just seems to always want to go up. Their business prospects going forward are outstanding, and Mark Zuckerberg is a neighbor of mine, lives in my neighborhood. You can't miss that hoodie as it jumps in and out of the, as the limo SUVs. Financials starting to look interesting. When we do get higher interest rates or hints of interest rates, you want to own financials. Now, if you're not a bank analyst like I used to be, then you want to buy a basket. You can do that with the XLF, X-Ray Lima Foxtrot. That's a basket of major financials, including JP Morgan, Bank of America, Citibank, and Goldman Sachs. It's already made about 2/3 of the losses up from the February meltdown. Buy the dips. I think this thing goes up for the rest of the year. If they don't raise in June, they certainly will raise in December. Here's Bank of America, laggard in the group. Still plenty of room to play to the upside. You can buy the calls either at the money, out of the money. You want to play it really safe. Buy something like a 12-13 call spread 1 or 2 months out. That would be an easy money maker. Might get a quick 20% return on that one. Biotech, political football this year, but the earnings never stop growing. Thank the politicians for giving us a great entry point. Both parties are beating up the sector. I think the closer we get to the election, the better this sector starts to perform because no one will need to talk about it anymore. talk about how horrible or how profitable. By the way, talking about how profitable the drug companies are is a reason why the stock should go up, not down or sideways as it's been doing for the last year. We did have major positions in this in the last several years, got everyone out at the absolute top last July, been sitting on my hands ever since. Palo Alto Networks also got a nice entry point here from the February crash. Hacking isn't going away. This company's earnings are going to triple in the next 3 years. Good entry point setting up. Again, another one of our long-term favorites. Just waiting for general market conditions to improve before we go back in. China, the bad boy and font of volatility. No news is good news. Sideways works for me. Lets the rest of the world go up. China isn't going to crash. Jim Chanos is wrong. I talk to people in China almost every day, and things there are much better than the economic data reflect. European hedged equity, I think both Japanese and European markets will outperform the U.S. this year, maybe by a margin of 2-1. However, as long as the euro is strong, you don't want to go near the area, and it's been the rising dollar, which is only started a week ago, which is starting to eat into the euro. So as soon as the euro starts to weaken substantially, you want to go pouring back into European equities. That'll be your buy signal. Japan, same deal. Got killed by a sudden 10% gap up in the yen during the crash in February. It's now giving that back. Once we start getting to new lows in the yen, stock market should take off. Foreign currencies, dollar Fed boost. Fed interest rate hike warning gives U.S. dollar a new leg up. Should continue at least until the June 17th meeting. If we get a rise then in rates, the dollar should continue strong for the rest of the year. If we don't, the dollar is going to give up all of the gains that it just made in the last 3 weeks. So mark that on your calendar. June 17th, Fed, dollar, watch out. We did get a one-day rally in the yen, but it gave it up quickly, means the top is definitely in the yen for 2016, short every rally. Brexit polls have been running even until recently, but recently have started to favor staying in Europe. That is causing a short covering rally in the pound. Not too late to play that. You'll see on the chart, there's a nice little trade there. And with Aussie, the commodities topping out, you want to stay away from the Aussie and the loonie, the Australian and Canadian dollars. Here's your British pound long play. Expect the short covering to continue until the June 23rd referendum. I will be in England for the referendum, so it should be a lot of fun and games there. In the meantime, a lot of ripe possibilities here with a very solid bottom. It's even a head and shoulders bottom right here. So you can see that's where people really started pouring in on the long side once this right shoulder held. Euro also staying quite strong. It's since given up a lot of these gains. We were short, made good money on that. Japanese yen, we are long now. The 94.91 vertical bear put spread. That's a bet that the yen does not trade above 91 by the June 17th expiration date, which is in 16 trading days. So far, so good. My guess is that's the top. We may get one attempt to put in a right shoulder here, and then we really collapse down into the low 80s. There's some big money to be made in the yen. A lot of big hedge funds. Yen was their top performing trade last year. They're looking for it to do the same this year. Here's the euro more recent chart, updated. Didn't take the old slide out. We're all the way down to 108 now. We did take profits on our 1316 bear put spread. Energy is levitating. No one wants to chase oil up here. A lot of the buying you're seeing is forced short selling. But at 94 million barrels a day, the world is still producing 2 million barrels a day more than it needs. Almost all of the buying this year has been short covering. Huge fires in Alberta are keeping 1 million barrels a day of tar sands off the market. That's helped. We've also had supply disruptions in Libya, Iraq, and other places. So oil's had a bunch of lucky breaks here. It's not going to last forever. Stronger U.S. dollar also was oil negative. Iran is ramping up production, and the U.S. rig count is flattening. And this is the mystery with oil. Inventories have been rising all year and are at an all-time high. You can't find a teacup in the Midwest to store excess oil right now. Something like 200 tankers are steaming in circles around the world waiting to sell oil at higher prices. But oil has moved 100% during this whole time. Double in oil against rising inventories, go figure. I've done a few quickie short trades here, but got out very quickly when the wind started to go against me. Oil, you'd think it'd be topping out here right around 50. We shall see. But if the global economy accelerates faster than I think, then you could get up to 60 very easily, maybe even 70, who knows. United States Oil Fund, we took profits on our put spread last week, made a quickie money here, and then didn't go back in because I want to see if this 200-day moving average is going to hold up here or break. Exxon, the problem with oil stocks now, you can't touch them with a 10-foot pole. They have far away outrun the price of oil. $60 is already in the price, maybe even 70. People are just buying this for the dividend, which is still around 4 and change. So stay away from the oil stocks. They basically have had their run. In January, I predicted that banks and energy would be the top performing stock sectors of the year, and that has absolutely turned out to be the case. If you must go into energy, goes to the MLP basket, the Alerian MLP. That gives you a 9% yield. You can then wait out any volatility that happens in the meantime. And you have a basket approach with a couple of dozen holdings that diversifies your risk. Copper, the bottom is in. There's a really good range here, 206 to 230. I expect that bottom to hold probably for the rest of the year. You want to trade that via Freeport-McMoRan, which went from $3 to 15 or 14 and change and back down again. So probably at a buy level right around here, close to $10. This thing came down from the 60s, I believe, a couple of years ago. Precious metals, we got ambushed by the Fed here. Prospect of an imminent Fed rate rise takes the air out of the global gold trade, which had been a hedge fund favorite and one of the top performing asset classes of this year. With other low interest rate plays like utilities, REITs, and telecoms, gold has taken a hit. With the most leverage, gold miners took the biggest hit. Silver, platinum, palladium are all following gold into the penalty box. The only other driver of precious metal is inflation, which is nowhere to be seen. And that is a picture of me in the Istanbul gold market doing some early Christmas shopping last summer. Yes, I do get around a little bit. I have global strategy lunches in 25 different cities around the world, which you are all invited to attend. Gold, we came out here on the day of the Fed minutes and played these longs all the way, all year. Just putting on calls and call spreads all year and stopped out right here when the thing started to roll over. GDX taking the big hit here, down 20%. Even when it was rising, I was telling people to stay away because it doubled in 3 months, ran too far, too fast. Silver, again, rolling over like all other precious metals. This usually has double the beta of gold, but, wait for the Fed to not raise interest rates in June. This whole asset class just goes to the moon. You get giant gap moves on no Fed move, in, no Fed move in June. Agriculture, been a disaster area. Margin calls forcing farmers to dump grains at low prices, capping any rallies. Midwestern banks are calling in their oil loans as they go bad, forcing them to also call in ag loans. Big storms hit the coast but missed all the big growing areas this year. Strong dollars demolishing exports. El Nino didn't cause the damage people were hoping for. No trade here, no fish to fry. Wheat flat on its back. This is the most globally traded ag product in the world, so most affected by a strong dollar. And there it is sitting at a bottom. And that's a 5-year bottom, people. This has just been a disaster area. Soybeans has been on fire lately because farmers decided this year to shift some planting from soybeans into corn, tightening up the supply of soybeans a little bit. We're seeing that in the prices. DBA, though, isn't buying it. Just a tiny little rally off the bottom. Not much. Stay away. Real estate, the last big bull market. Housing inventory at a 30-year low. Impossible to buy a home in a good school district. We are still 40% below normalized housing starts, meaning new construction has to double to meet the old peak. Millennials are finally having kids. Who knew? So household formation is about to take off. Apartment vacancies are on the rise for the first time in a decade as renters shift to buyers. And housing boom has another decade to run. And by the way, Jeanette, I can get you a great deal on an apartment in San Francisco. Unfortunately, the earth is falling out from under it. But, you know, real estate is so tight in the city. People are desperate for anything. Prices are rocketing. Here's the Case-Shiller S&P. See the 09 here. This grind up will continue for another decade. And here's where the big action has been. My own neighborhood of San Francisco, followed by the subprime neighborhoods of Vegas, Phoenix, and Miami. New York's sitting on the bottom. I guess that's because the banks are laying off a lot of people. And Washington is imminently expected to see major turnover in their real estate market around November. Here's the Home Construction Index, ITB. You want to be in this on the long side for the long term. Got a nice spike up this week. Watch the short covering rally because it kind of tips the cards of the long-term players. It shows you which sectors they want to buy. Lennar Homes, one of many in the basket, also a good long-term buy. So do you want to be told exactly how to earn profits on every trade? You want true financial independence, the ability to work from home wherever and whenever you want, kind of like I do. Tell your boss to take a hike and live the lifestyle of your dreams. That's me sitting on the $55,000 owner's suite on the Queen Mary 2, which I take every summer to Europe, where I do my work. Are you tired of conflicted broker research? Clueless talking heads telling you what to do, getting ripped off by underperforming mutual funds, investment letters and trade mentoring services that promise the world but deliver never-ending losses. Then you want to join one of the world's most exclusive clubs. Get the same legal insider information I reveal to the world's top hedge fund managers. And this is one of my long-term clients, David Tepper, the world's top performing hedge fund manager. Average annualized return in the last 40 years of about, the last 25 years of 40%. I hook up with him every year. Do you want access to the same trading ideas I charge monster hedge funds up to $100,000 a year for my consulting advice? Then come sit with me, John Thomas, the mad hedge fund trader, at my personal trading desk. Discover how you can tap into the top performing trade mentoring service in the industry, up 30% a year, 38% a year in impossible markets. Follow my research and market beating trade alerts and you will rake the profits in. If you don't believe me, listen to the thousands of followers. I have a couple of testimonials here, and while you read this, I will answer some questions that have come in by email. Joseph in Portland, Oregon is asking, is the election affecting the stock market? Absolutely, Joseph. It is unnecessarily scaring people out of stocks, taking them underweight in a bull market. That leaves them chasing short covering rallies like this week. Dan in Topeka, Kansas, what is the minimum amount of money I can start with? Dan, I'd say $10,000 to be safe, but I've seen people do it with $5,000, and we have a lot of students trading out of dorm rooms for as little as $400, which is about the smallest position you can take. Jim in Dallas, Texas is asking, are the trade alerts for stocks, ETFs, or options? Jim, the answer is all of the above. Every trade alert we send out has a range of possible securities with every trade alert, so readers can tailor it to their specific needs and risk profile. You get recommendations on options, stocks, ETFs, and even futures. Joe in Detroit, Michigan is asking, I've never done this before. Can a beginner do this? I'll put another testimonial up here. And the answer to that, Joe, is absolutely. Bringing beginners into the market for the first time is one of the primary goals of this service. David in Boca Raton, Florida. How much money should I put in your program? I would say start with 10% and then move it up when you become satisfied with the results. Hundreds of traders earn a full-time living only with the Mad Hedge Fund Trader alerts calling the shots. And one more, Joel in New York City. How often is the newsletter sent out? It is sent out every trading day of the year, which is about 250 days a year. Let me tell you how I do it. You get the smartest, best of the best, distilled information converted into a simple, easy to understand trade alert. I send it directly to your inbox and smartphone, ready for you to act right at a market sweet spot. I follow the trade for its entire life, tell you precisely when to get out and take profits, and I have the best track record in the industry. That record can be yours as well. Let a Marine combat pilot steer you into big profits. And no, that is not the plane I flew in Desert Storm. I did fly a somewhat more modern version of an airplane. It's called a C-130 Hercules. But for fun and games, I do like to fly vintage aircraft. This is a 1932 Tiger Moth, which I flew in England last year. We trade single stocks, options, ETFs, and futures for global equities, bonds, foreign exchange, energy, commodities, precious metals, real estate. Basically, we trade everything all the time, looking for the best longs and shorts. Who else wants to bank a six-figure profit? And let me get on to some more questions here. Type in questions in your question box in the meantime. We'll get to those if there's time. Mary in Kansas City, how many trade alerts do you send out? About 200 a year, but depending on what the market is doing, we either send out none in a week or we can send up to 5 or 10 out in a day. You don't get sweet spots very often in the markets. We only trade when we want to, not because we have to. You're trying to buy your yacht, not your broker's. Elizabeth in Montana, do you think the Fed will bring back QE, and do you ever get to Montana? I wish I got to Montana more often. I think one branch of my family owns about a quarter of the state, which they got at a great price right after Custer's last stand. As far as QE, I don't think they're going to bring back QE now, but we may go into the next recession near zero interest rates, and if that happens, then we will get QE in spades, as well as negative interest rates, Elizabeth. Is the strong dollar continuing? Ask Janet Yellen. She knows. And you may find out as early as 7:30 or 10:30 EST on Friday, because she's giving a speech at Harvard University. If the Fed raises rates, the dollar is going to be off like a rocket. If it doesn't, it's going to go back down to the lows for the year. It's that simple. Jim in Houston, Texas, is oil bottom. For sure, Jim, I would say yes, the 26 is looking rock solid, but we may get another $10 dip just to flush out the hot money before we take another run at the highs. One more question. You can read this. Let's see here. What is your best stock in the market today? I would buy Apple right here, right now. If you have some discipline, wait for another $3 or $4 pullback. Stock's been going down for a year. We've dropped 35%. We're now getting ready to run up to the iPhone 7 launch in September. 2.5% dividend. Warren Buffett's buying stock. Apple is buying stock in competition with Warren Buffett, and they have a PE multiple of 8. So did I mention they have $230 billion in cash? Does that cover it? I hope so. Let me show you how these trade alerts work. On January 14th, I expected continued sharp market sell-off. The SPY then was at 191.93. I sent out a trade alert, which looks like this. Buy the S&P 500, April, 185 puts for $5.56. I give you all the details of the position. It cost you $5,000 to get in. Let's see what happens. Here is a screenshot of my personal trading account showing the 556 price, where I got it from. And what happens? Next day, market drops 2.15% down to 187. Do I sit around and do research, twiddle my thumbs, watch CNBC, wondering what I'm having for dinner? No. I get on my computer again. I send out a trade alert. I say, get out. Take profits. Sell the S&P 500 April 185 puts at 793 or go to the market. That meant our put position was now worth $7,000, giving us a one-day 42.6% profit. They don't always work this well or this fast. It does give you an idea of what we do. And we do send out 200 of these a year. 96% return in 45 days. You can read this and I'll answer some more questions. And we have here, let's see, got the best stock pick. Cheryl in Fort Lauderdale, Florida. How do we find out your trading positions? Once you become a member, I email them to you every day and post them on my site. We're totally transparent. We want you to know what we're doing all the time. Robert in Seattle, Washington, will there be a recession? No, Robert, not this year, not for 3 or 4 more years. None of the traditional causes of recessions, high interest rate or high oil prices, are anywhere to be seen. George in Austin, Texas, when does your letter come out? Every day. It's in your box a couple hours before the market opening every morning. And let me move forward again. One more testimonial. I'll skip this for now. With my Global Trading Dispatch service, you get a daily research newsletter, trade alerts, bi-weekly global strategy webinars like this one, invitations to strategy luncheons around the world, unlimited access to my 9-year database. And I'll even give you the name of a good surfing camp in North Africa, which has a seniors division. I spent my summer there last year. This is the real deal. I charge big hedge funds $100,000 a year for access to my trading ideas. For my concierge service, I charge $10,000 a year. That gets you my personal cell phone number, which you can use as an investment 911. I charge my pro clients $4,500 a year for 12 months, but not for you. Today and only through this webinar, I'll give you 3 months of our service for just $497. Creating this product cost me millions of dollars. Running it cost me millions of more. But that doesn't matter to you. We just want to give you the chance to make the money to pay for your own subscription in 90 days or less, like many of my subscribers do. Just click on the link in the chat box for more information. And Jeanette, if you can post that link in the chat box, it'll take people straight to page on my site with all the information they'll need to participate.
Cool,
This is
John.
a
We just
limited
posted
time.
it, so it's there right now for you.
Say again?
We just posted it for you, so it's down in the
Oh,
chat
thank
box.
you. Okay. Well, click away, and I'll take a few more questions. We have a few more minutes. I can only take 25 new subscribers at a time because we don't want to overwhelm the market. It's first come, first serve. I can't wait to share my knowledge with you, and I want to make you into a legitimate moneymaker. People ask why I do this. It's purely from the satisfaction of making money for other people. I've retired 4 times in my life. I failed every time. This is my retirement. I love getting up every morning and looking for great trades for people. So let me make the money for you to pay for your own subscription, make the trades, discover how an experienced hedge fund manager finds and exploits the best sweet spots in any of the main markets. Who's going to tell you which stocks to buy at the summer market, summer bottom? I will. Just click on the chat box on the right for the link to more information. Last chance to get in. I'll make the money in the market for you to pay for your subscription. And you can buy your own Tesla high-performance Model S1 for $110,000. That's mine out there. I had one of the first ones ever made, chassis number 125, and that's my old Nissan Leaf before it. And I'm getting a new Model X, which is $120,000 in October. So just click on the link on the chat box on the right. Here's the offer you can't refuse. Click on the chat box on the right for more information. So that is it. So let me go and ask any more questions. I'll assume the link is still on the right. Let's see what else we have here. Jim in Palo Alto, California. Are you an algorithm? Well, Jim, if I knew any good machine noises, I would be doing them right now. But no, I'm a person. I've been doing this for almost 50 years. The good news is it gets easy at 50 years. If you want to find out for sure, come to one of my strategy luncheons, check me out, meet me in person. Pinch me if you're not sure. If you cut me, I bleed. The stuff that comes out is red. Ivan in Portland, Maine. How would you describe your trading philosophy? I would use fundamentals for your long-term calls and technicals for your short-term execution. It's what every long-term pro does. Too many young traders rely too much on technical analysis. I always think of this as heads you win, tails I lose type of trading strategies. They're right 50% of the time, which means they can't beat a coin toss over time. And even the big hedge fund traders only use them in determining their own short-term order execution. That said, the shorter the time frame you look at, the more valuable technical analysis becomes. And if you look how day traders work, they're only looking at technicals. They're not really paying too much about fundamentals. In fact,
John, are you still there? Can everybody still hear John?
let's see.
There you are, John. You're back. You're back. We lost you for a second. You're back there.
Oh, okay. Right. Well, I have pretty much said all I had to say. Would love to make a ton of money for you. Look forward to working with you all in the future. Are there, Jeanette, do you see any more questions arriving in your question box?
Okay. The last couple of questions, did you answer? Do you trade futures at all? Did you see that question?
We give recommendations everything we trade has a futures contract behind it. We don't give exact price points on futures, but we do give directional calls on all asset classes all the time. So that is the utility. About 25% of our readers are full-time futures traders and use this for directional guidance. Do you provide trial periods? Fei Hu is asking, I guess you're from China. This is the trial period, $497 for 90 days is a huge discount to our regular prices. Fred's asking, what does it cost after 3 months? The answer is $3,000 a year, and people are happy to pay it because they're usually making far more money than that. Jack is asking, where's the link? It should be in the chat box on your right. Jeanette, if you can make sure it's there so Jack can find it.
Yep, it is, John. We posted it in the chat and responded to the questions. And just so y'all know out loud, the link is simply tradethirsty.com/John Thomas. So it's www.tradethirsty.com/John Thomas. And that redirects you to his site.
Fred's got a good question here. How do you stay so well connected in so many markets? Fred, I've worked in all of these markets at some point in my life for a decade or more. And I just keep the contacts. I keep the Rolodex. And I want to talk to a top expert in an industry. I just call up my friends, say, how you doing? And they want to find out what I'm thinking, and we trade informations. And my contacts are global in all markets. So it's taken me 50 years to build it up. I'm happy to share that information with you. Kathy, a great presentation. You're in Foster City. Hello across the bay in Foster City. You're right next door to Oracle, I guess. Will there be a replay sent as I came in late? Anne Marie is asking, Jeanette, will there be a replay? I don't know.
Yes, certainly. We are recording in several locations, and we will have the replay out probably in the next 24 hours, assuming all technology stays in check with us. And John, we're at the top of the hour, so I'm going to give you a chance to answer one more question, and then I'm going to take the mic back from you.
Okay. We got a question here on uranium. I did cover uranium up until Fukushima, and after that, it was just a giant buzzkill for the whole industry. But we do follow it because uranium miners are a big deal down in Australia and also up in Canada. So this is John Thomas signing off for today. Look forward to working with you all. Just click on that link to get more information about our services. This is John Thomas, the Mad Hedge Fund Trader, signing off for today. Good luck and good